Welcome to the Deep Dive. We're here to get you up to speed fast on complex topics.
Today, it's all about DLocal's latest Q2 2025 earnings.
We've dug into their reports, the presentation, the earnings call, and even some Zacks analysis.
Yeah, our goal is pretty simple. Pull out the key facts, figures, and strategic moves so you get the full picture.
Okay, let's jump right in. Big picture. DLocal had a very strong quarter.
Definitely. Significant achievement is the right way to put it.
So the earnings per share came in at 14 cents. That beat the Zacks estimate of 13 cents.
By over 7%. And, this isn't totally out of the blue for them.
They've beaten EPS estimates 3 times in the last 4 quarters.
Exactly. It points to consistency, reliable execution. It's not just a one-off.
And revenue. That looked even stronger relative to estimates.
Oh, absolutely. $256.46 million. That just blew past the consensus estimate by 11%.
Wow. And compared to last year?
Huge jump from the $171 million or so they did last year. And again, they've topped revenue estimates twice in the last 4 quarters. It shows a good rhythm.
Okay. Impressive top-line beats. But let's dig a bit deeper into the core metrics. Total payment volume, TPV.
Record high, $9.2 billion.
Which is massive growth.
Huge. Up 53% year over year, 14% just from the previous quarter.
And you mentioned constant currency before? How does that look?
Even better, actually. Up 65% year over year in constant currency. That really strips out the FX noise and shows the underlying business momentum.
Got it. So that strong volume must be feeding into revenue and profit.
Directly. Revenue hit $256 million. That's up 50% year over year, 18% quarter over quarter.
And in constant currency terms?
That's 63% year over year growth for revenue.
Okay. And gross profit?
Also strong. $99 million. Up 32% year over year.
What about adjusted EBITDA? That's always a key one for operational cash flow.
Another record, US $70 million, soaring 64% year over year. That's a really powerful sign of underlying operational health.
In the cash flow itself, free cash flow, FCF.
Very strong, $48 million generated. That's up a massive 156% year over year.
Okay, so TPV, revenue, gross profit, EBITDA, FCF, all pointing way up. But net income was actually down slightly. What's the story there?
Right. It's a key detail. So reported net income was $43 million, which was down 7% year over year.
Okay.
But, and this is important, it was hit by the Argentine peso devaluation impacting their bond portfolio there.
So a currency issue.
Exactly. And management actually used it as a chance to act strategically. They moved funds out of Argentina efficiently, cut their bond position there by over 80%, and shifted into U.S. Treasuries.
To reduce risk?
Precisely. Reduce volatility, free up funds. The CEO even pointed out that if you exclude those specific effects, net income would have actually been $53 million.
Okay. So they took a short-term hit on the reported number for a better long-term position.
That's the idea. Proactive de-risking. It shows they're thinking ahead.
Makes sense. So beyond that specific item, what else stands out in terms of efficiency?
Well, what's really fascinating is the operational leverage they keep showing. The adjusted EBITDA over gross profit ratio, it improved again. 5th quarter in a row.
Wow.
To what level? Reached 71% in Q2. That signals really disciplined investment, getting the business size right, even while they are still investing heavily in tech product compliance.
So they're growing, but also getting more efficient at the same time.
Exactly. Their revenue per employee is actually higher than many bigger players. It points to a lean culture.
And tech plays a role there. AI, automation.
Big time. They mentioned ongoing AI and automation initiatives. Get this, 70% of customer service tickets now handled by AI.
70%.
Yep. And it cut the median response time from 2 hours down to just 16 minutes.
That's incredible. A huge impact on cost and customer experience, I imagine.
Definitely.
Okay, so operationally strong. How about geographically? Lots of moving parts in emerging markets.
Always. It's a dynamic picture. Core markets like Brazil looked great, 86% gross profit growth over 2 years. Mexico solid too, up 10% over 12 months.
And diversification.
Crucial. Growth is still fastest outside those core markets, which helps spread the risk. Vital when you're operating across so many different economies.
Any specific challenges?
Well, Argentina saw strong volume, which helped profit even with lower FX spreads. Management seems committed there. But Egypt was tougher.
Why is that?
They lost some volume from a large merchant implementing redundancies, plus the ongoing FX devaluation hurt results there.
Okay.
And some other LATAM markets, like Chile and Colombia, had some specific retry costs, basically, costs when payments fail and need to be retried. That dinged margins a bit.
But still growth overall in those areas.
Yeah, excluding those specific costs, growth was still 9%. And Africa and Asia, outside of Egypt, performed very well. South Africa was a standout.
So it underscores the value of not having all your eggs in one basket.
Absolutely. Diversification is key to their model.
Let's look at what they're processing. TPV breakdown. Verticals. Pay-ins versus payouts.
Yeah, growth was really broad-based across both pay-ins collecting money and payouts sending it out. And across flows, too, cross-border and local to local.
Any specific verticals really shining?
Commerce was huge, up 85% year over year. Remittances exploded, up 186%.
Wow, 186%.
Yeah. SaaS, ride-hailing, on-demand delivery, streaming, all showed good positive growth, too. Advertising was the one weak spot, down 32%.
And the flows, pay-ins, payouts?
Pay-ins hit $6.4 billion, up 50% year over year. Payouts reached $2.8 billion, up 60%. And cross-border TPV saw really significant growth, 75% year over year. Local to local was solid, too, at 35%, so broad demand.
Okay, let's zoom out a bit. These numbers are impressive, but the potential market seems, well, enormous. Can you give us a sense of that scale in emerging markets?
It really is staggering. The estimate for the emerging market digital payments market, $2.1 trillion this year, 2025.
Trillion.
And is projected to double, hit $4.2 trillion by 2030.
That's hard to even wrap your head around.
Right. And think about why. Credit card penetration in these markets is just 11%. Compare that to 65% in G7 countries.
So most people don't have cards for online payments.
Exactly. DLocal is building that bridge. Plus, you have lower internet penetration still, around 78% versus 90% in G7, but it's catching up. And crucially, higher average GDP growth, about 4% in emerging markets versus 1.5% in G7.
So a huge underserved market that's also growing faster.
Precisely. Massive untapped potential that DLocal is directly targeting.
And they have this interesting S-curve model for how they approach this with merchants. Can you explain that?
Yeah, it's quite insightful. They see merchants typically starting in developed markets, right?
Yeah.
Then they try expanding to emerging markets, often using standard international acquiring methods.
Which often doesn't work great.
Right. Low conversion, poor user experience because it's not localized. So as merchants get serious about an emerging market, they realize they need to localize payments. Add local methods, maybe start in the bigger EMs first.
And then move to smaller ones.
Exactly. They gradually move along this S-curve, adding more countries, more local payment methods. DLocal positions itself as the partner that enables this entire journey.
So they become embedded. Sticky.
Very sticky. They're not just processing payments, they're providing the essential infrastructure for expansion into these complex markets. It creates a strong competitive advantage. They see themselves in the early stages of this S-curve playing out across emerging markets.
And we're seeing that deepening relationship in the numbers.
Absolutely. They now serve almost 760 merchants. And get this, their top 50 clients. They now work with DLocal in an average of 11 countries. Up from 8 countries just 18 months ago. And they're using an average of 48 payment methods now, up from 35. It shows much deeper integration.
That's significant growth within existing clients.
And the geographic diversification continues. The top 3 markets are now 47% of revenue, down 8 points since 2023. Revenue in the other markets is growing almost 3 times faster.
Reducing concentration risk.
Exactly. And that's reflected in their net revenue retention rate, NRR, which is still very strong at 145%. Shows they're growing with their clients significantly.
Okay, growth with clients, growth into new markets. What about new products? Innovation.
They highlighted a few key things. First, Smart Pix in Brazil. It's their own solution, they say, first in the market, that makes Pix payments automated, recurring. Kind of like having a card on file.
Simplifying a popular but sometimes manual process?
Right. Then there's BNPL Fuse. It's a buy now, pay later aggregator they built for emerging markets.
An aggregator. So they connect merchants to various BNPL providers.
Yes, offering really wide BNPL coverage, reaching over 530 million users. And the smart part, DLocal just takes a revenue share. They don't take the credit risk themselves.
Clever. Tapping into the BNPL trend without the risk. Anything else?
Stablecoin and remittances. They're positioning themselves as an on- and off-ramp across emerging markets using their footprint and local FX capabilities. They mentioned a partnership with BVNK as an example, leveraging crypto rails for potentially more efficient cross-border payments.
Interesting. And strategically, they also picked up new licenses.
Yeah, 3 new ones are authorizations, UAE, Turkey, and the Philippines.
How important is that?
It's quite significant. If you connect it to the bigger picture, it's about expanding their regulated footprint. It lets them offer merchants more financial services compliantly in those key markets, reinforcing that local expert advantage.
Okay, so strong performance, strategic moves, product innovation. What does this mean looking forward? They updated their guidance for 2025, right?
They did, and it was a significant upward revision across the board. Shows a lot of confidence.
Let's hear it, TPV.
New guidance is 40% to 50% year-over-year growth. That's up from the previous 35% to 45%.
Okay. Revenue.
Now guided to 30% to 40% growth, up from 25% to 35%. A clear signal of acceleration.
And on the profit side?
Gross profit guidance jumped significantly, now 27.5% to 37.5% growth, way up from 20% to 25% before.
Wow. And adjusted EBITDA.
That saw the biggest jump. The new guidance is 40% to 50% year-over-year growth. Previously, it was 20% to 30%.
That's a massive increase in the EBITDA outlook.
It really is.
Yeah.
Reflects the strong first half and their expectation that the momentum continues. It's confidence backed by execution.
Very bullish guidance. But they must have acknowledged risks, too. Operating in these markets isn't always smooth sailing.
Oh, absolutely. They were clear about the risks. The global macro environment, currency fluctuations, trade issues impacting consumers in emerging markets.
Any specific countries or issues?
They mentioned potential impacts from increased tariffs on e-commerce in Mexico, changing tax rules in Brazil, and always the potential for currency devaluations or capital controls in places like Argentina and Egypt.
So the usual suspects for emerging market volatility.
Pretty much. But, management stressed that their disciplined approach, their deep local knowledge, and their focus on merchant value are exactly what helps them navigate these kinds of volatile environments. It's kind of their core strength.
Right, turning volatility into an advantage through expertise. Okay, shifting gears slightly, leadership and governance changes.
Yes, a couple of key appointments. Guillermo Lopez Perez is the new CFO. Comes with tons of experience from Visa, Amex, and fintechs like Tink.
Solid background.
Yeah. And Christopher Strohmeyer joined as SVP of Corporate Development and is now also leading investor relations. Background in strategy at Bain and Latin American fintech Uola.
And they thanked the interim CFO.
Yes, Jeffrey Brown, for his work during the transition.
Beyond people, there were governance enhancements mentioned, moving to a more independent board.
That's a really important step, I think. They committed to transitioning to a majority independent board. They're actively searching for more independent directors.
And setting up committees.
Right, nominating and governance, and compensation committees. These are standard best practices, but crucial for strengthening oversight, improving decisions, especially for a global company like DLocal. It boosts investor confidence.
Makes sense. And one last thing, they're canceling treasury shares. What's the significance there?
Basically, it signals financial health and confidence. It underscores their ability to grow the business and have excess capital potentially available to return to shareholders later, maybe via dividends or buybacks. It tidies up the balance sheet and aligns with good governance.
Okay, let's try and wrap this all up. A really strong Q2 from DLocal.
Definitely. Beat estimates, record TPV, impressive efficiency gains, despite navigating things like the Argentine peso issue.
Plus, continued innovation with smart picks, BNPL Fuse, stablecoins, and strategic expansion with new licenses.
All while tackling that huge emerging market opportunity with their S-curve strategy, building deeper client relationships.
And that confidence is reflected in the significantly raised guidance for the full year.
Yep, very bullish outlook, even while acknowledging the inherent market risks. And crucially, they're also maturing their corporate governance structure.
It seems like a company firing on all cylinders, balancing growth with stability and governance.
That's a good way to put it.
So here's something for you to think about. How might DLocal's focus on that deep local expertise, combined now with this investment in an independent board, redefine resilience for payment platforms in volatile emerging markets? What could that look like in the coming years?
And maybe also consider the broader implications of that S-curve strategy. What does it mean for the future of digital commerce across the global south as more merchants follow that path?
Definitely some interesting things to mull over.
Food for thought.
Thanks for joining us on this deep dive into DLocal's Q2. We hope you feel up to speed.